when it comes to debt, right, before we actually get into that specific part of the presentation, we want to talk about goal setting and thinking beyond today. We want you to have a SMART goal. And what does that mean? It's actually an acronym. It means specific, measurable, attainable, relevant, and time-bound. And what does that mean specifically? Well, here you go. We want you to create SMART goals with specifically your money, because that's what we're talking about today. So when you make a goal, it doesn't matter what the goal is. And we're not saying a SMART goal would be to, to pay off debt, or although it is a SMART goal, right? It can be anything. When you're setting goals, for example, if you want to buy a TV or whatever your goal is, we want you to make it specific. So when you are creating your goals, you want to ask yourself, what am I trying to achieve here? SMART goals are very specific to suggest action. Here you can see an example. I want to save enough money to go to Italy. We don't just want to say save money. We want to be as specific as possible. A SMART goal is measurable. So you want to ask yourself, how much money do I need to achieve my goal? How will I know when I've achieved my goal? So you have to be able to measure it. Third, it has to be attainable, or you need to be able to reach that goal. So is this actually doable? Can I actually reach my goal, right? Right now, it might not be the right time. Is it relevant? Is it something I really want? Is now the right time to do it? And finally, it's time bound. So you want to ask yourself, by what time must this goal be achieved? So going back to the first example, I want to save enough money to go to Italy, right? If this was a SMART goal, you would say, I want to save enough money, but not enough. How much money do you need to save? By when do you need to save it? What's the date? Is right now the right time? What if you're in school? It might not be the right time. You might want to wait till the summer, right? And if this even achievable, do you have employment that you can actually save money to make that goal feasible? So many things come into creating goals, and this is a good way to think about it when you are trying to reach those goals: specific, measurable, attainable, relevant, and time-bound. Managing income and expenses. So when you're managing your expenses and your incomes, the first thing you want to do, if you are in a situation where you might not have enough money to cover your bills, this is how you should be doing it. And this is from the Consumer Financial Protection Bureau. And I'm going to ask the other panelist who's on here to put the website of the CFPB on the chat for you. If so, Chella, if you can please do that. This is where we're getting the information. So prioritizing bills. So you want to consider protecting your income, your shelter, your assets before sending a payment for other bills. So the first thing you want to do is protect your income above anything. So if you miss a car payment, you may have to, pay a late fee, and you risk possible repossession of your car, a negative entry on your credit report, which lowers your credit score. If your car is repossessed, you might have to, have trouble getting it back and pay extra fees, which is going to put you at risk to losing your job, right? So paying your car payment is going to protect your income. So that's what we mean when protecting your income. You have to protect your job, whatever income that is, and how would you protect it? So when you're paying your bills, or if you're in a dilemma, you need to, figure out what bill to pay first. You want to pay the bill that's going to protect your income. In this situation, it would be your vehicle. Secondly, you want to protect your shelter. So if you're late with rent, you might have to pay a late fee. You can possibly risk eviction. If you don't pay your utility bills, they may be cut off, and then the utility companies are going to ask you to pay more to reconnect, right? So that's the second bill that you want to pay, protecting your shelter, whatever that means, whatever protecting your shelter means to you. Third, you're going to want to pay your obligations, because if you're late with your obligations, such as a credit card, you may have to pay a late fee again. You're going to also risk having a negative entry on your credit report, which is going to lower your credit score, which is going to raise your interest rate. So, and if you don't pay court order obligations like child support, you may face legal consequences. So that's the third thing you want to pay, are your obligations. And then fourth, you're going to protect your assets and your health. So like not having insurance may mean that you can't drive, and put your assets at risk, including your health and your family's health at risk if it's like insurance or whatnot. So once again, when you're prioritizing your bills, the first one you want to protect is your income. The second one you want to protect is your shelter. The third, pay your obligations. And fourth, your assets. And let's go on to the next one. I see somebody put in the chat, they want to know if the recording is going to be sent out. Yes, Chaloke, if you can please answer that question and let them know. Then the next slide is paying bills and other expenses. So you need to, when you're prioritizing bills, you want to ask yourself, is this a need, a want, or an obligation? So needs are things that you must have to live. An obligation, it's going to include those debts that you owe and payments you've been ordered to make. And wants are things that you would like to have but can survive without. And this is going to look different for every person. My needs, my obligations, my wants are different from yours or from everybody here, right? We know what our needs are, we know what our wants are, we know what our obligations are, and they're going to look different for you and for me. So that is something for you to determine. The first thing that you want to do is you want to track the sources of income, and you want to do this for an entire month. And here again, it's another great resource from the CFPB, from their Your Money, Your Goals toolkit. And so they have these online, there's apps for this, or you can, write it down. So you're gonna track everything. What do you get from a job, from a second job, if you're self-employed, if you're receiving benefits such as Social Security, and things like that. You are gonna write that down. You're gonna write down the frequency, and you're gonna write down what happens every week when that money, comes in, how much it is, to see when it's coming in, how much. It gives you a reality check, right? It says, okay, this is how much I have. This is when it comes in, before you start doing anything else, like creating any sort of schedule or payment plans or anything. You want to track that source. And like I said, for at least a month. Once you have that and you know how much money you have coming in, then you want to, again, take a look at your bills and see when they're due, how much they are and when they're due. So again, this is from the CFPB. Do your bills match, when you receive income? And if they don't, you want to try calling, whether it be your utility company, your credit card companies, or any place or person that you owe bills to, you owe money to, and ask them to modify that. And they're more than likely willing to do that. So for example, most bills are due the first of the month, right? But you get paid twice a month. So if all your bills are due on the first and half of your income is coming on the first, that doesn't really make sense, right? So you want to call, let's say, for example, your credit card company and ask them to change that credit card bill payment that's due maybe on the 16th, when your second check comes in, your work check. So then you are not feeling overstressed or without any money those first 2 weeks of the month. And like I said, most most companies are willing to work with you to modify when that payment is due. And this is going back kind of to, is it a need, a want, or an obligation, right? So you want to track and analyze your spendings. So track your spending for at least 1 month, like we said that. You want to analyze your spending. Is it a need, a want, or an obligation? And then you want to adjust your spending habits. So here you can see 3 boxes. The first one says spending that cannot be cut. So you would write in that box, what are things that cannot be cut and the reason why? Then the second box is spending that can be eliminated and steps to eliminate that. So for example, a credit card, right? We can try to eliminate that. And then steps that you would take to try to eliminate that. And then the last box says spending that can be reduced. And what is that new spending target? And this can be whatever it is, right? Let's, for example, Starbucks. We get a nice coffee Monday through Friday while we're at work. But can that be reduced? Yeah. So instead of spending, let's say that coffee costs you $5, Monday to Friday. So now you're spending $25 a week, a work week. Instead, maybe saying, I can reduce that. Maybe I just get myself a coffee on, Fridays, for example. So that would be your new spending target. And this can be applied to different things. So this is another great tool put up by the CFPB that you can find at the link that is in the chat. Then once you've done all of that, then you want to create a budget. And I'm not going to go through this a lot so we can get to the debt portion of the presentation. But again, there's apps for this as well. If you bank, your bank might even have something that they offer. So you would put in the first column all your income coming in, second column everything that's going out, and then you see really what you have coming in. And in this case, this person is in the red, right? They're spending more than they are bringing in. So they're living above their means. And here's some ways to increase income. Here you see a one-time activity that could increase your income, such as holding a yard sale, or garage sale, selling things online, claiming tax credits. Sorry about that. Right now we're in tax season, right? So right now is a great opportunity to increase your income. Even if you do not have a filing requirement, you should consider filing your taxes, even if you don't have to, because there's tax credits that you are only able to get if you file your taxes. So I would encourage you to file your taxes, especially if you work, because there's tax credits such as the Earned Income Tax Credit, or the EITC, that is offered by the federal government and the state. There is also, if you have children, there's tax credits for if you have children, such as the CTC, the Child Tax Credit, or the Young Child Tax Credit. If you're foster youth or were in the past, there's tax credits for you. And you can go to freetaxprep.la.org to get your taxes done for free if you make under a certain amount. And I believe it's in the like $62,000 a year. You can get your taxes done for free by IRS certified volunteers that have a great record. So highly encourage you, because this is going to give you thousands of dollars, up to thousands of dollars back in your pocket, under $64,000 to qualify for free taxes. Thank you, Chalo. So filing your taxes can put hundreds, if not thousands of dollars in your pocket. So please consider filing your taxes, even if you don't have to. And then also another way other ways to increase your income regularly might be asking for a raise or working additional hours if you're able to, changing your tax withholding. If you receive a large tax refund, you might want to consider changing that, and getting part-time jobs now with driving and things like TaskRabbit and things like that. It's easier to get part-time jobs that way. Also, how to improve your monthly cash flow. You want to increase, again, sources of cash, income, and other financial resources, including public benefits and applying for tax credits, like we mentioned earlier. And you want to decrease your spending or uses of cash and other financial resources. And you want to match the timing of sources and uses of income where possible. So this is going to put you in a better situation financially, trying to increase your income, decrease your spending, and then matching when you get your money to when you pay your taxes. Now we're going to get into dealing with debt, your rights regarding debt, verifying debt, and managing debt. So what is debt? Well, debt is an amount you owe for borrowed money. And how is debt different from credit? For our purposes here today, credit is the ability to borrow money, where debt is the result of using credit. Do you have too much debt? Well, what is your debt to income ratio? So this is a great formula to figure out if you have too much debt. Your debt to income ratio is a crucial data point used by lenders to determine whether you are approved for certain types of loans, such as buying a home, for example. Your DTI, which is what we call debt to income ratio, can help you determine how you should handle your debt and whether you have too much debt. And it's a basic calculation formula. So you divide the debt and your income, and that is going to determine your DTI. And here we can see an example from the budget that we saw earlier. So the things that are highlighted are the things that are part of your DTI, but there's certain things that you don't include in your DTI, such as utilities, groceries, insurance premiums, healthcare expenses. So even though you have to pay for those things, they're not included in your DTI once a company, for example, is determining whether to give you a loan. So in this case, as you can see here, this person is at 60% of the DTI. So what does that really mean? Is this person good, bad when it comes to their debt to income ratio? Well, let's see. So here is what it says. If your DTI is less than 35%, your debt is manageable and you most likely have money left over each month. If your DTI is between 36% and 49%, your debt is okay, but if you want to get a loan, it might help to reduce your DTI. And if it's more than 50%, that's more of half your income going towards your debt. And you may have to limit funds left over each month, and you really need to reduce your debt at this point. And some ways to lower your DTI is creating a budget, creating a plan to pay off that debt. You're making your debt more affordable, so getting more money, and taking action. Don't take on additional debt. So let's go back to the previous slide. So this person, as you can see here, is at a little over 60%, 60.43%. So this person is above that 50%, which means, again, they probably don't have a lot of leftover income, and they're not really reducing their debt because they're probably not saving either, because they're just living above their means. So if you want to determine your DTI, again, you would add up things that are included, your credit cards, your car loan, your student loan, mortgage payments, rent, child support, alimony. Personal loans are just a few. You would add what that is, and then so that's divided by how much money you're bringing in, and then that is going to determine your DTI. And then once you do that, you can look at this here and then know where your percentage falls, and then it'll tell you what your DTI is. And then here are two methods to getting out of debt. So there's a snowball method, which is you reduce your debt. It's a strategy to reducing your debt in which you pay off your bills in order of smallest to largest, regardless of the interest rate. So if you have, a car note, a credit cards, personal loans, things like that, you would look at all of these bills and see which one is the smallest, and then you would pay that one off first, then going to the second smallest, and so on and so forth. The avalanche strategy is one that you would tackle the one with the highest interest rate first, regardless of what the balance is. Now, financial experts suggest that you do the avalanche one first, because by paying off the one with the highest interest, interest is just your money that you are, giving away. It's money that you are paying to have borrowed that money. So by paying off the highest interest, you avoid, throwing away money, for a lack of a better words. But, and here's the but if you feel like you need to get motivated, right? And if that motivation is caused by seeing one bill being eliminated, then the snowball method is better for you. Then that's perfectly fine. The point is to get out of debt. So whether you do the snowball method or the avalanche method, that is totally up to you. If you need that extra encouragement by using the snowball method, by seeing those credit card debts being removed, and that's perfectly fine. Whichever works for you, the point is getting out of debt. We do want to note about cosigners here, because a lot of people get into trouble or have debt by being cosigners. So as a cosigner, it means that you have the same obligation to pay the debt as a borrower. You're just as responsible. And this can result in having to repay any missed payments that the original debtor has missed. And you as a cosigner, you get no benefit, right? You didn't borrow the money, you didn't get the whatever, the vehicle, whatever you co-signed for, but you're still as responsible. And it's gonna affect your credit score, your ability to get a future loan if the person is not paying their bills. It's also gonna affect you because now if you have to jump in and pay, it's gonna affect your pocketbook. So it's going to affect your wallet, and it's going to affect your credit score possibly if you are a cosigner and that person doesn't pay their bills. Now, remember, if somebody's asking you to cosign, it's for a reason, right? They probably may not have the income to pay, right? Also, they may have already bad credit. They might have been irresponsible in the past. So that is why they need a cosigner. So just be mindful that this is may put you in a worse situation, even though you are trying to be helpful, you're trying to be a good person. Just be aware of the consequences. Let's talk about some statutes that from California. So creditors have 4 years to sue on a debt here in California. What does that mean? Well, a creditor has 4 years to start action from the date that you missed a payment. If it has been more than 4 years since your debt went delinquent, this is what is called time barred debt, meaning the creditor cannot sue you on the debt. Again, a creditor can sue you. Let's say your account goes into collections and they want to take you to court, they have 4 years to sue you. If after the 4 years they try to sue you, you can always, go to the judge, if they filed some sort of action, and you can let the judge know that they didn't sue you within the 4 years of the missed payment. And then that could thrown away. Does this mean that you owe the debt? Yes, it still means that you owe the debt. It just means that they can sue you, and it's still going to be on your credit report. But again, they can't sue you after 4 years from the date of the missed payment. However, and this is a big however, if you make a payment on any debt, even a small payment, the statute of limitations starts all over. So if, let's say the collection agency calls you, or the law firm calls you, and they say, you know what, you owe this debt. We know you fell on hard times, but we know you're a good person. Even just make a $10 payment toward this debt, and you make that $10 payment, then the 4 years start all over again if you miss a payment. So please be very careful. If you don't have money to pay this debt, you just simply don't have the money, you don't have a job, do not agree to pay, and don't pay anything, because you start the statute again. They might not even sue you, so don't agree to pay if you don't have the money. What you can do, is, if you don't have the money, you can send them a letter, stating, I do not have the money to pay this debt. I will not be paying it. I do not have the money right now. And you can send that in, go to the post office, send it with a receipt, get a receipt. They can call you one more time after they received it. But if they keep on calling you and harassing you, you can actually sue them in small claims court. Now, the consumer protection laws that you can look up regarding this is the Fair Debt Collection Practices Act, which is a federal law, and the Rosenthal Fair Debt Collection Practices Act, which is a state. But what debt collectors can do is they can contact your employer to try to collect. They can confirm your employment and make sure you work there. They can sue you if you neglect collection attempts and get a court judgment or garnish your wages. They can contact another person to confirm your location or enforce the judgment. And they can definitely add interest to debt owed, if specified in the agreement of the original debt or directed by law. So there's things that they can do. They can try to locate you. They cannot, and we're gonna actually, before I go on, let me go to the next slide, because we're gonna talk about this one, what they cannot do. They cannot falsely misrepresent themselves. So falsely state that they are an attorney, a government agency, provide false ID or name, falsely state that the act of debt is a crime or an emergency. So a debt is not a crime in regards to, they cannot arrest you and put you in jail. We do not have debtors jail here in the United States. So they can't say they're going to arrest you for owing a debt. There's only two debts that you can be put in jail for, and that is not paying your taxes and child support. That's it. They cannot put you in jail for owing money on a credit card or owing money in a house or anything like that. They cannot threaten to disclose information about debt to employers or acquaintances. They can call your employers and acquaintances to try to locate you, but they cannot talk to them about the debt that you owe. They cannot harass you, and they cannot contact you between the hours of 9 p.m. and 8 a.m. unless you agree to. So those are the things that debt collectors cannot do. Now, if any of debt collectors are doing this, we encourage you to please file a complaint in our office. You can go to, again, dcba.lacounty.gov, or give us a call and let us know that these collection agencies are doing any of these, and we would love to investigate. So if you are being harassed, if they're misrepresenting themselves and things like that, please file a complaint with our office. What does it mean to be sued? It does mean that you can be forced to pay money if you lose. It doesn't, again, not mean that you can go to jail or have any criminal penalties. Again, it does mean that you can be forced to pay money if you lose. So if you lose, they can, there can be a judgment against you, obviously, but they can also garnish your wages, put a levy on your home if you have one. They can go into your bank account and pull the money that way. Obviously, they need a court order from a judge to do that. But they can force you in that way to pay money if pay the money you owe them if you are sued. What else do you want to say? So please, if you are a victim of identity theft, if you have paid these debts and they're suing you, still you want to make sure that you go to court, go in front of the judge and let them know that either you're a victim of identity theft or it's mistaken identity. Maybe you have a really common name, or maybe you already paid this debt and you have the proof, you have proof that you've paid them. So you want to tell the judge, because what happens sometimes, let's say you're a victim of identity theft, or if you already pay this debt and you don't go in front of the judge to, support whatever evidence you have, then the judge is going to automatically side with the other party. Now, if you didn't pay because you were sick, a family member died, you lost your job, sometimes it's actually better not even to go to court, because those are not excuses for not paying your debts. They're reasons, and they're valid reasons, right? If somebody passed away, if you lost your job, those are valid reasons for not paying your debts. But that's not, that's not an excuse. So the judge really does not want to hear that. So if you go to court and tell the judge, you lost your job, somebody died and whatnot, you're still going to owe the other party their money, because it's still money that you owe. And by going to court, you might also now have to pay, court fees, obviously, or the other party's attorney fees, or whatever the situation that may be. So, just be aware of repercussions of not only not paying the debt, but what it means to be sued and to owe the money that you owe. Now, if you do owe the money, and before I go to that side, and let's say you do owe the money and maybe you can't at this moment, you can't pay the full amount, but you want to pay a portion of it, you want to come to some sort of deal, or maybe you want to go into some sort of payment plan because maybe you're working part-time, maybe you can afford just to pay a little bit at a time. We have mediators here in our department that can assist you to contact the collection agencies or the companies where you owe money. So I really would encourage you to use those services that we offer here through our mediation unit if you want to come to some sort of agreement. Of course, this is something that you can do yourself as well. You don't need to use our mediators if you feel comfortable enough to have a payment arrangement. We would encourage you to do that on your own. But if you don't feel comfortable and you want to use our services, you can do so as well. Dealing with tax debt. So there is a great organization that is actually part of the IRS. It's called the Taxpayer Advocate Service. So if you owe the IRS money, but you're experiencing a harm as a result of some tax issue or economic harm, you can call them. There's a number, and they can assist you with that. Now we're going to talk about building and maintaining a healthy credit. You want to use credit wisely and maintain a healthy credit score so you don't get into debt, right? So how to build credit without a credit card? You want to pay the loans that you already have. You want to pay them on time. You want to obtain a secured credit card if you don't have a credit card. You want to ask for help from family and friends so if they can even though we said be careful about being a cosigner, if you need a cosigner, cosigners are helpful if you want to build your credit. You want to participate in lending circles, and we're going to talk about that in the next slide. And you want to ask for credit where credit is due. What does that mean? That means, for example, if you're a renter, most uh, uh, rent is not on your credit report, right? But it's where most people always pay on time. They're going to pay their rent for their home, for their apartment before they pay their credit card bills. And that is not being shown on people's credit reports. So ask your landlord to please put it on your credit report if you are paying your credit, if you're paying your rent on time every month. And then that'll help boost your credit score. Now, how to rebuild credit if you at one point you had bad credit or you have bad credit at the moment. You want to start paying your bills on time. You want to keep credit use to under 30%. So a very simple example would be, for example, you have a credit card, you only have one credit card, and your credit limit is 1,000. You only want to use 30% of that. So that means you want to only charge up to $300 on that credit card and no more. That is going to raise your credit score. So don't close all accounts in good standing if you don't need to. We've heard that before in the past. You want to maintain a mix of active trade lines. What does that mean? Well, that means that if you don't only want to have credit cards, you want to have different types of loans or debts, if you will. So maybe you want to have a car note. Maybe you want to have a student loan. Maybe you want to have uh, like an American Express charge card. So if you only have, for example, credit cards, that's your only type of loans, that is going to lower your credit score. The credit bureaus or FICO, they want to see a different types of credit. And 6 months of good history and activity is going to raise your credit score. And obviously, you want to get help with debt if you need it. I mentioned lending circles in the previous slide. So a lending circle is a social form of borrowing money that's been around for a very long time. It's very cultural worldwide. They're known as tandas, cundinas, susus. They have different names in different parts of the world. I want to do it in a safe way by contacting these nonprofits. Safe alternative credit building products. Credit builder loans. Credit builder loans go by many different names, such as fresh start loans or starting over loans. They're not widely advertised, and they're generally offered at smaller financial institutions, such as credit unions and community banks. And approval is based on your income. The money you borrow is deposited into a savings account that you typically cannot access until you have repaid the loan in full. So on-time payments are reported to the credit bureaus, and at the end of the loan term, you get the money. So this is a great way to get a loan and build your credit. And again, they're not really advertised, so go to your local credit union or your local community bank to see if you can get one of these loans, and then this will help you build your credit. Secure credit cards, we briefly mentioned this in the previous slides, but these cards are backed by a cash deposit that typically have lower credit limits and more fees than an unsecured or a traditional credit cards do. APRs tend to be north of 20%. The clients are responsible for paying at least the minimum due and interest on the outstanding balance. So secured credit card is backed up by your money, but it does boost your credit score, and it still offers all the protections that a regular credit card has, unlike a reloadable debit card, which doesn't offer any protections. And, if you lose it, it's gone or whatnot. So a secure credit card is a great way to build your credit. And we have less than 10 minutes, so I'm going to go a little bit faster here. But debt consolidation, what does it mean to consolidate your debt? It means that your various debts, whether it be credit cards or other type of loans, are rolled into one monthly payment. So if you have multiple loans, credit cards, consolidation may be a way to simplify or lower those payments. But please keep in mind that debt consolidation loans does not erase any of your debt. And at the end of the day, you might end up paying more. So please do your homework, because many of the low interest rates of your consolidation may just be like teaser rates that are just at the beginning for a certain amount of time, and then they increase and have you have to pay more at the end. So although your monthly payments might be lower, it may be because you're paying over a longer time, which means that at the end of the day, again, you might be paying more overall, including fees or cost of the loan that you would have already paid if you continue just making regular payments on your credit cards without the consolidation. A tip for you, if you are considering a debt consolidation, make sure that you're comparing the terms and the interest rate on how much interest and fees you're going to pay overall. This can help you pick the loan that saved you the most amount of money, or maybe even going the route of debt consolidation. And then we want to just give you a warning about credit repair scams. We've seen a lot of these. You've maybe seen, these signs that said credit repaired, bad credit, you need credit repair, only $500. So some warning signs with these companies: they tell you not to contact the credit reporting agencies, they ask for an advance fee, they don't give you a contract, they don't explain your legal rights, they promise you a new credit history, they tell you they can remove information from your credit report even if it's accurate. So just be very careful. All they're doing is disputing accounts with the credit bureaus. All they're doing is telling Experian, Equifax, and TransUnion that they're just disputing them. And so while these accounts are in dispute mode, what the credit bureaus do is they remove them from your credit report for 30 days while they're conducting the investigation. So what happens is, you go to these companies, you pay them the $500, the company disputes all these accounts, which again, you can do yourself by simply going online to Experian.com, Equifax.com, TransUnion.com, and disputing them yourself, which is very easy to do. And when they're in the dispute mood, they tell you, okay, here's your credit report. All your negative accounts are, have been removed. And so you think, great, I have good credit now. They removed all the negative accounts. And then once the 30 days are up, and sometimes it'll go even up to 45 days, all that information is put back on your credit report. If the collection agency or the other party said, no, this is a correct account, they owe us this money, here's the proof, they're going to put it back on your credit report. So please be careful. Again, they need to offer you a contract. They can't be asking for advance fees. They need to explain what your rights are. They can't promise you anything because they don't know, right? They don't know if they can they can't give you a new credit identity. So again, this is something that you can do yourself. Don't pay anybody to repay your credit without a contract, because a valid account is a valid account, and they just can't magically have it disappeared. Okay, so here is a great website that that we offer. It's called Get Ahead LA, or in Spanish is Avanza LA. You can go to avanzala.org or getaheadla.org. You're gonna find great resources here. So if you're in need of credit counseling, credit coaching, if you want to file your taxes and are looking to where to go to file your taxes, if you are looking for, you know, where to stay, or you need food, you can go here, and these are all vetted by us, and great resources again to have in your back pocket if you ever need to